162.46. The price just sliced through the R3 resistance at 162.45, and the herd is piling in long, convinced this is the breakout of the year. But I see something else entirely. This is not a clean breakout. It's a liquidity trap, engineered right on top of a geopolitical powder keg. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. The market is pricing in a melt-up. I'm going to show you what's priced wrong right now. My session bias is fading this breakout. Let me be clear. The trend on all timeframes is a strong buy. Weekly, daily, 4-hour, even the 1 hour, all printing higher highs and higher lows. But when every timeframe screams buy and geopolitical risk spikes, that's exactly when the smart money sets a trap. The yen carry trade is the most crowded position on the planet, and an oil shock from the US-Iran war headlines is the classic trigger for a violent unwind. So I am looking for a failure at 162.45, not a continuation. The single invalidation level that flips this bias back to full-on bullish continuation is a 4-hour close above 162.70. Write this number down. 162.70. If we get a firm 4-hour candle body closing above that, the structure resets, and we are chasing a melt-up toward 163.50 and beyond. Until then, I am positioned for a fake breakout and a sharp reversal. And here is the micro insight about the herd. Retail. Positioning data this morning shows over 70% of speculative accounts are net long. That liquidity is sitting right above 162.45. Market makers know exactly where those buy stops are resting. They will run those stops, grab that liquidity, and then slam the door. That's the game plan. Do not be the liquidity. Be the one who trades the trap. Let's walk through the charts, starting from the weekly and drilling down to the 15-minute. On the weekly, we are in a strong bull trend. The 200-week moving average is nowhere near. It's around 157.17, acting as a massive anchor. Price is comfortably above it, and the weekly MACD is still in positive territory. No top formation here yet. The daily chart also shows a strong buy. Price is holding well above the 50-day MA at 160.71 and the 100-day MA at 159.45. That is a trending structure, no question. The daily ADX is a robust 49. That's a powerhouse trend reading, almost 50, so momentum is not weak. But strong trends can still produce violent counter moves, especially when they become too extended emotionally. Now, zoom into the 4-hour. This is where the trap is being set. The 4-hour moving averages are stacked bullishly. The MA20 sits at 161.68, the MA60, which is the 60-period moving average on this timeframe, aligns roughly with the dynamic support area around 160.71 on the daily, but on the 4H it's climbing. Price is above all of them. But look at the MACD. While price is pushed to a new cycle high of 162.46, the MACD histogram has made a lower high. That is a textbook hidden bearish divergence. Most retail traders only look for regular divergence, but hidden divergence in an uptrend tells you that the last push higher is losing thrust. It often precedes a liquidity grab above resistance before the actual drop. This is the signal that professional traders use to fade the breakout. Here's what most traders miss. They see price-piercing resistance and they buy the breakout. But the hidden divergence is whispering that this breakout is running on fumes. The smart play is to let the breakout happen, let the stops get hunted, and then enter short when price snaps back. I'll give you the exact entry in the setups. On the 60-minute chart, the moving averages are tight. The 5-period MA is at 162.08. The 10-period MA is at 162.03. The price has just ticked above them. The RSI on the 1 hour is at 60.9, not overbought, so there is still room to run if momentum continues. But the stochastic oscillator is at 72 and starting to curl lower from an overbought condition, which is a near-term exhaustion warning. Williams % R is at negative 18.45, also in the upper range. These oscillators are hinting at a pause or pullback. Now let's anchor the levels. The pivot point for today is 162.08. That's also where the 5-ma sits. It's the immediate floor. Below that, support 1 is 161.71. Support 2 is 161.52. Support 3 is 161.34. These levels are built from classic floor trader calculations, and they align beautifully with price structure. The 161.34 level is the key daily swing low. A break below that would confirm a deeper correction to the 50-day MA at 160.71. On the resistance side, R1 is 162.08, already flipped to support briefly. R2 is 162.26. R3 is 162.45. We have already pierced R3. That is the exact zone where false breakouts thrive. The ATR is 0.7407. So the pair moves about 74 pips a day on average. That means a move from 162.45 down to 161.34 is 111 pips. A 1.5 ATR range, entirely plausible in a single session, especially if a carry unwind accelerates. Let's connect the news directly to price action, because this is where the narrative web tightens. The 24-hour core headline: Japan has no plans to overhaul its pension fund's asset allocation, according to sources. That is mildly yen positive because it signals the massive GPIF is not about to dump yen bonds for foreign assets, reducing yen selling pressure. But that is a mere ripple compared to the tidal wave building from the US-Iran war tensions. Oil prices are spiking, and when oil rips due to a Middle East supply disruption fear, the yen behaves in a very specific way. The yen is a funding currency in the carry trade. Traders borrow cheap yen to invest in higher-yielding assets like U.S. equities. When geopolitical risk explodes, those risky assets get sold, and the yen gets bought back viciously. It's a carry unwind, and it can send US dollar to Japanese yen into a freefall that ignores all technical supports. The yield differential still heavily favors the dollar. The US 10-year yield is around 4.5%. While the Japanese 10-year is at 1.5%. That's a 300 basis point gap, a colossal incentive to stay short yen. But in a risk-off event, that gap can become irrelevant for a few days because the velocity of yen repatriation overpowers the carry. We saw it happen repeatedly in 2022 and 2023. The intervention ghost is also in the room. The Bank of Japan and the Ministry of Finance have drawn a line in the sand at elevated levels before. While they haven't intervened verbally today, the mere threat, the ghost of intervention, sits above 162 like a ceiling. If US dollar to Japanese yen accelerates toward 163 too quickly, expect jawboning or actual intervention to spike yen demand. So my 1 to 2 week directional lean is bearish US dollar to Japanese yen below 162.70. I'm targeting an initial move down to 161.34. Then the 50-day MA at 160.71. The exact event that invalidates this bearish view, a daily close above 162.70 combined with a sharp retreat in oil prices. If oil rolls over and geopolitical fears ease, the carry trade gets a green light and the melt-up resumes. But as long as oil holds its bid, the unwind risk remains elevated. Here's your second interaction trigger. Do you think the dollar breaks 162.70 this week? Comment yes or no right now. I'm tracking the community consensus and I'll call out the result in tomorrow's video. Most people skip this section. That's exactly where the money is made. Keep watching, because I am going to give you exact entries, exact stops, and exact targets for 2 scalp strategies and 1 swing trade that align with this trap scenario. Strategy 1, the opening scalp, scalping, high probability. Despite my bearish fade bias, there is a high probability long scalp on the pullback to the pivot, because even in a reversal, liquidity must be tested. This scalp plays the immediate mean reversion. Price has just poked above 162.45 and is likely to retest the pivot zone at 162.08. Here's the trigger. Wait for the 5-minute chart to print a bullish engulfing candle right at the 162.08 level. That's the MA5 and the pivot floor. Entry on the candle close above 162.10. Your stop loss goes at 162.00, just 8 pips below, giving the trade room to breathe under the pivot. Take profit 1 sits at 162.30, which is a 20 pip gain for a risk-reward ratio of 1 minute and 2.5 seconds. If momentum picks up and price pushes back toward the highs, take profit 2 is 162.45. The entire scalp is voided instantly if a 5-minute candle closes below 162.05. That would mean the pivot is breaking and the trap is probably already triggered in the opposite direction. This scalp is a quick snipe for those who want to capture the bounce before the potential dump, the opening SCLP entry, 162.10, 5M bullish engulfing at pivot 162.08, stop loss, 162.00 take profit 1. 162.30 take profit 2, 162.45 risk, reward. 1:2.5 are invalidation, void if 5M candle closes below 162.05 strategy 2, the liquidity grab, scalping, counter noise, using 15-minute chart. This is the trap trade. The setup relies on a classic stop hunt beyond the session high. We have a 3 at 162.45, and stops from breakout buyers are piled just above it. Watch the 15-minute chart. The trigger condition, price makes a sudden spike above 162.45, tapping 162.55 or 162.60, running those stops, and then within the same 15-minute candle or the very next one, it closes back below 162.45 with a bearish engulfing or a long upper wick. That is the fake breakout confirmation. Enter short immediately on that candle close below 162.45. Place your stop loss just above the wick high, exactly 162.65, giving the trade 20 pips of room while keeping risk tight. Your fast, singular target is the nearest intraday liquidity pool, which is the pivot zone at 162.08. Take profit at 162.10 for a 35 pip gain. This trade delivers a risk-reward of almost 1 minute and 1.75 seconds, and in fast-moving liquidity grab scenarios, it often gets filled within minutes. Warning: this requires fast execution and a cool head. If price closes back above 162.45 on the 15-minute without a wick rejection, do not enter. The trap has failed, and the breakout is real. The liquidity grab entry, short 162.45, after 15 minutes spiked to 162.5560 and closed back below 162.45, stop loss, 162.65 take profit, 162.10 risk, air reward, 1:1.75 are invalidation. If 15M candle recovers and closes above 162.45 again without a long wick now, interaction cliff. Are you scalping or swinging this week? Comment scalp or swing below. I want to see where this community sits, and I'll track the sentiment for the next video. Strategy 3, the session swing, trend alignment. This is the trade for those who want to capture the multi-session carry unwind move. Based on the 4-hour and daily fade bias, we are waiting for a structural trigger. The entry condition, a 4-hour candle close below the 20-period moving average on the 4-hour chart, which currently sits at 161.68. Additionally, I want to see the 4-hour MACD signal line cross below the MACD line, or at a minimum the histogram print a solid negative bar, confirming the momentum shift. So entry on a 4H close below 161.68 with a bearish MACD cross. The stop loss is placed outside the daily structure above the invalidation level, exactly 162.75. This gives the trade a 107 pip risk from the entry around 161.68. The first target, conservative swing, is the daily support 3 at 161.34. That's a 34 pip move, offering a risk-reward ratio of about 1 minute and 3.2 seconds if you take partials there, but I scale it differently. I treat it as a first target and then let the rest run. The stretch target sits at the 50-day MA, 160.71, a 97 pip move from entry. Once price reaches halfway to TP1, around 161.51, I move the stop to break even. This protects capital while giving the trade room to develop into the carry unwind. The invalidation that would shift the medium-term outlook, a daily close above 162.70. If that happens, the bearish structure is broken, and we are back to chasing the melt-up. The session. SWNG entry, short on 4H close below 161.68 with bearish MACD cross-stop loss, 162.75 take profit 1, 161.34 take profit 2, stretched 160.71 risk, reward, ~1:3.2R, to TP1, invalidation. Daily close above 162.70 never risk more than 1 to 2% of your account per trade. Scalps demand even tighter risk, because the speed can hide slippage. No positions through high-impact news. Today that's any fresh Iran headline or sudden oil spike. Stops are non-negotiable. This is how you survive to trade the next big move. The trap works only if you let it play out. Do not be the trader who refuses to cut a loser. Respect the 162.70 leveled SO here is the single most critical level for the next session. 162.70. That is the line in the sand. If bulls can punch a daily close above that, we are ripping toward 163.50 and all shorts are invalid. If bears hold that line and we see a 4-hour close below 161.68, the carry unwind gets a green light toward 161.34 and eventually 160.71. Tomorrow's wildcard. We have the US ISM services data and any escalation in the Middle East. If oil spikes another 5%, the unwind could accelerate well beyond my targets. I will have the updated blueprint exactly 24 hours from now, with all new levels if the structure shifts. If you want the full breakdown on trading gold as a fear architect, the S&P 500 liquidity tide, Bitcoin's risk asset shadow, and the other asset videos, they are live now. Tap the end screen and build your binge loop. Then hit the bell so tomorrow's alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before they move.